You're listening to QSBS Solved, where we share insights for founders and investors looking to maximize their business's growth, exit opportunities, and tax savings. Our team at QSBSrollover.com offers specialized services to help you benefit from owning qualified small business stock. Our podcast guests are leaders in their respective fields and work on every side of the startup journey to help founders and investors win. The ideas and opinions shared here are not investment, tax, or legal advice. Reach out and we'd be happy to connect you with a qualified advisor or tax counsel. For now, enjoy today's episode. Hey everyone, welcome back to another episode of QSBS Solved. I'm back again with Scott Dolson in part 4 of our QSBS Masterclass. This part on conversions, reorganizations, recapitalizations, and exchanges involving qualified small business stock. Scott, this is where it starts to get a little bit in the weeds for me and a touch outside of my comfort zone. So I'm glad that we have you on to talk through some of these and hopefully help founders and investors pay attention to some of these terms and how QSBS is impacted.
Yeah, I kind of think this is probably one of the articles I've written that a lot of lawyers have benefited from, because what I did when I wrote this article is, and it took some effort, which was try to drill through each type of reorganization that can be done and figure out what the moving parts are if you've got qualified small business stock involved. And it's not all just sort of like low-hanging fruit. You know, some of it takes some thinking exactly how these different things are treated. And I mean, frankly, you know, I know a ton of stuff off the top of my head, but if you ask me, 20 questions from this article, I'm not sure I'd remember off the top of my head every little thing. So this is the one situation where I would say we can talk about it for this period of time here on this podcast. But if somebody has a particular type of reorganization, either get with us or, read carefully, what we say about how it's treated. And that a critical issue is, do you retest 1202 eligibility requirements when you do one of these things or not? And in some cases, it's gray area whether you retest. And when I say retest, a good example is, you issued 1202 stock when you were worthless. And then of course you were worthless. And 2 months later, you were telling people your pre-money value was 10 million. But in any event, you weren't worth a lot, but now you're worth 200 million and you're doing some type of reorganization, exchanging stock for stock. Do you have to retest the $50 million or $75 million test or not? And that's where this is one of those potential gotcha areas where, it's like, don't do this at home kind of thing. You really need to, you need to have a definitive understanding of how it's going to affect the status of the stock that you've got, So that's not the nature of the beast here.
I'm really only smart enough to know when we need to talk to someone else. And so, I'll start with one common scenario and we can talk about transactions and ABC reorgs and other things. But the first one I want to speak to, because we see it the most often, and it's an executive or a founder from a company that was established in, say, Canada or in Germany, and maybe some of their founding team is in the US or some of their employees are in the US, and maybe they want to start raising capital from US investors. And they say, hey, we've issued stock out of this company that's, headquartered in some other country. Can we create a US-based entity and issue new stock, kind of move everything to the US-based entity to take advantage of QSBS and help our investors do the same? I know every situation is different. What are the first couple things that come to mind and the potential tripwires that we need to look out for in those situations?
Well, I mean, the first thing we try to do is get a handle on what they are. All right. I mean, and there's per se corporations, which under Section 7701 of the U.S. Internal Revenue Code are treated as corporations in the U.S. and cannot have any other treatment. And that instructs us then what to do. There's also corporations that are not per se corporations, which allow for the filing of a U.S. check the box election, which you can actually file. People actually file U.S. check the box elections to not be treated as a corporation, even if they're not doing anything in the U.S., because for these kinds of situations, so we find out what they are and what they've done in terms of the U.S., and then we go from there. I mean, what you want, you're dealing with two different things. I mean, we can always set up a U.S. subsidiary or corporation, and new investors can get 1202. I mean, we do have the issue if you have a parent corporation, you've got to worry about, the $50 million or $75 million test. So if you've got a corporation, even if it's a foreign corporation owning, 51%, we have that issue. But so aside from that issue, though, we can always issue equity to U.S. investors or non-U.S. investors investing in a U.S. sub. What we try to do more planning for, which is similar to the planning we do for an S corp, is try to find out what can be done in terms of allowing people that own equity right now in the company, this foreign company, actually get QSBS treatment on the U.S. investment. And that may be just a standalone brother-sister corporation, which isn't that unusual in the U.S., and allow, some of these people that are maybe are resident aliens, invest in the U.S. corporation because they're going to be filing U.S. tax returns, but it's really a bespoke kind of analysis. But the goal is to try to, with somebody who's not in the U.S., and they're not a U.S. citizen and they're not in the U.S., they're not going to pay taxes on capital gains on the sale of the U.S. stock. But if they're not in that category, what we want to do is, typically get QSBS in their hands. So we have to go in, dig in, and make sure that we've accomplished that for what we're doing.
Yeah, they're trying to open up lanes of capital for, a U.S.-based investment, right? And so it's important for the U.S.-based investors to have an option. And then a lot of times the founders in this situation are like, man, why didn't we set this up? Because one founder is in Germany, one founder's in New York, and he's like, man, why didn't we?
Yeah, the one in New York. The one in New York is, we don't want him to be out in the cold, right? We want, if we can. I mean, you can't always do everything you want to do, but we don't want to be guilty of not having thought it through.
Yeah, of course. Yes. Yeah, great. So I wanted to touch on that to start with, because we certainly I probably see, one or two of those a month, and that's not, for us, that's a lot because it's not at all what we deal with. But these are folks at early stages who are just trying to find someone to help them out. So let's talk a little bit more about the mergers, stock for stock transactions, stock for property transactions, and reorgs. These are type A, B, and C's. Give us the overview on the lettered types of reorganizations and what they mean.
Well, I mean, the mergers, type A transactions are structured as a merger transaction, either a straight merger between a target and an acquiring company, or a triangular merger transactions. I mean, you can either be on the sell side on those or on the buy side on it, right? In terms of planning. But I mean, typically at least 40% of the consideration has to be stock. So if we're trying,
let's stay on the sell side, right? So let's think about.
Well, if we're on the sell side, I mean, number one, I mean, you sometimes see mergers that are all cash mergers, so fine, they're all cash mergers. If you are being asked to roll equity over into a acquiring company, you typically don't want to get taxed on that until you have the sale of the stock that you get. So in order for that to work as a tax-free reorganization, you would want to at least 40% of the consideration, the total consideration to all of the target shareholders, has to be stock. Now, the management team could end up having to roll all their equity over, while the rest of the people, investors, might roll nothing over. But it has to add up to 40%. So, that where this gets in the weeds is, outside of the real basic, like stock for stock deal, where, you're just getting the stock. And the question is, am I getting QSBS of the acquirer, or are they too big and it's non-QSBS? And then my ability to claim 1202 is capped at what the capital gain would be if I actually sold my stock today. The thing where we get more into the planning is they want me to roll equity over, or they want some people to roll equity over as a target person, and how to do that in a way that works from a tax standpoint. I mean, there's really only three things you can do. You can hold on to your equity and just be left out of the deal, just keep your shares. I mean, that you don't see that, but that's possible. Another thing is you can be part of an acquisitive 351 transaction, which is the formation of a new corporation, and you put your stock in there and you get back stock and money, or maybe just stock, and the buyer puts their business or money in there. And so you're both kind of forming this holding company. I mean, you see that on kind of one-off smaller deals. Like you see that on a platform company. Like if I'm working with a PE firm,
roll up,
and they're set on the first one, with the platform, you see a 351. But after that, they can't keep stacking holding companies on top. So you don't get it anymore. And they typically don't roll over. They typically don't give 40% of their equity. So it really only works the first time. So 351 will work for those initial, platform kind of formation transactions, as long as we can keep the money down below the 75 million today. And then there's the reorgs, now the A's probably where the action is. I mean, if it's a stock for stock or property for stock deal, B or a C, you have to have a much higher share of the consideration being stock. And if it is, that's fine. You fit within one of those. But A is really where most of the action is, because 40% isn't that far from the normal rollover of maybe 20, 25%. So if you're a seller and you want to, you want to have a rollover and preserve the right to claim 1202 down the road, you need to have the deal structured where at least 40% of your consideration, not yours personally, but like I said, all the shareholders, the target people, adds up to 40% stock. So, I mean, that's kind of like, so A, B, and C, I'd call those kind of acquisitive, A, B, and C reorgs, acquisitive type reorg things. And then the 351 transaction, which is the non-recognition exchange, are acquisitive 351s. They're used by buyers to get your equity and pay you money, or a combination of money and stock,
Yeah, let's then skip down. Can we skip to F reorgs?
Yeah.
I think probably we see the most of. Tell us similar. Well, we didn't talk about D&E, but similar to D&E, I guess. I'll let you take it from here on Type F, but it would be redomiciling a corporation, or it could mean redomiciling a corporation.
Yeah, I mean, if I'm an LLC and I become a real corporation, that would be an F reorg. If I'm a New Hampshire corporation and I redomicile Delaware, that's an F reorg. It's like a one entity. It's not an acquisitive reorg with two players. It's a one player reorganization. The question on these things are, do we retest the aggregate gross assets test or not, and so how we structure these things, and that's true on D, E, and F reorgs, which we can kind of go briefly. But F reorgs, it's really just redomiciling from one place to another, or change it. It's like type and identity, domicile.
Mhm.
that type of thing.
Yeah. Then let's get back and do D&E.
Yeah, yeah,
Go ahead.
yeah. Well, a de-reorg is a reorg where I have a corporation and I want to have two corporations, and I want the corporations to be owned brother, sister, that shareholders own equity of both. It doesn't have to be an even split. I don't have to distribute equity out pro rata. You could have the group A shareholders and the group B shareholders, and the A's want the pet stores, and the B's want the tobacco shops or something. So we split the companies up. A lot of these divisive reorgs you used to see with families fighting with each other. So you split the McDonald's restaurant, corporations into, somebody gets these locations and somebody gets those locations. So de-reorgs are actually, reasonably common. You do have to do the retesting on the size thing. So, that's an issue for a de-reorg. And there's all funky things like, in order for it to be a de-reorg, technically you have to form the corporation for it to be a de-reorg. If you already had a subsidiary, it would be a 355 spin out. The rules are actually the same, but 1202 only refers to the reorgs. So, you've got to form the corporation as part of the distribution of the stock of that corporation. So the only thing I can say about that is this is another one of those little things, sort of don't do on your own at home. You need to read the article and then consult with a tax advisor on these and make sure that your tax advisor understands that 1202 stocks involved and understands what that means in terms of having it involved. Because
what we care about is like whatever stock is owned currently after all this happens, what's the basis of it? What's the holding period of it? Did a tripwire happen that doesn't?
Yeah. I have Corporation A stock is 1202 stock. Now I own Corporation A and B stock. Are both of those 1202 shares? That's the critical thing. And we need to make sure that we've done the work we need to do to make sure they're both 1202 stock. Now, an e-reorg is recapitalization of the company. It might mean we had common stock. Now we're bringing in some new investors, or we're issuing some equity to employees, or we're doing something where we want to change the cap table and maybe, for instance, introduce either a new class of preferred in there for some of the existing equity, change some of the common to preferred. We want to do something like that. And we're making changes and basically saying, you people who had this, you now have this kind of equity, that type of thing. So that gets done pretty regularly, but where 1202 is involved, that there again, it's the same question. Have we done things in a way where we had 1202 stock? Do we now have 1202 stock?
Yeah.
1202 explicitly says if you own convertible stock and you convert, that's 1202 stock. But this isn't what we're dealing with here is stock that's not on its face convertible. We've just converted it. We've adopted a plan of conversion, and filed new articles that said, this changes to that. So, okay, what have we done for 1202? We've done a stock for stock exchange. Where do we stand now with 1202?
Yeah, this is a little bit tangential, but came up recently. And I know we touched on it just briefly before we started this part, but where a founder is raising capital and maybe they have an oversubscribed round, they're able to sell some secondary. And so outside investors coming in, the founder is selling common, but the investor wants preferred.
Yep.
How do we make sure that the investor receives preferred stock in that scenario, and the shareholder doesn't have to do something wonky like redeem their stock or do some kind of buyback? I don't know.
Well, I mean, there's there's a fair amount of action on that, particularly out in sort of the Silicon Valley area. The classic scenario is that, the founders and other owners are allowed to sell some of their shares in a secondary sale to get some liquidity during a priced round, and so the company facilitates finding a buyer who will buy those shares for what is being paid for the priced round of preferred stock. I mean, that's not that uncommon. And then sometimes the company converts the shares that are bought, the common to the preferred. I mean, the issue, so you can sell. So if you're sitting there and you're a founder and you got a big slug of stock, I mean, you can sell some of your shares. And if you meet the eligibility requirements, you could either claim 1202, or if you haven't met the requirements, you can, get involved with 1045, right? So you can do that. So the question though is, if you've sold your shares for more than the current 409A valuation, what's the tax treatment of the amount you were paid in excess of the current 409A value for the common stock? And I've run into situations where companies have taken the position and issued either W-2s or 1099s, or treated it that way, where the excess above the 409A value is treated as compensation, on the theory that, that the common stock is only worth what the current 409A valuation is. And, I've got mixed feelings about that position, but I will say 409A applies technically in a very narrow area. It applies to basically setting the strike price on non-qualified options. And, there's some specific rules under 409A dealing with those annual 409A valuations that, it's not revenue really 56-60, which says basically, the value of something is the arm's length fair market value, what, sort of buyers will buy it for and sellers will sell it for. So the standards are different. The 409A value may be evidence to an appraiser, but isn't dispositive of what the stock is worth. But it's an issue that I think you need to be aware of from two perspectives. I mean, if you're a company, you need to be aware of the issue, and you need to, and what I think they're concerned about is they're concerned that if they don't do something, it'll undermine their 409A valuation, and on the sell side, you don't want a nasty surprise of, finding out that the general counsel of the company is advising the company that they need to treat that excess amount as compensation. And I mean, you got to get that issue out up front, because, what the company's position is going to take in terms of tax reporting is going to drive the bus, right? So that's a big issue. Other than that, you've got to worry a little bit about, redemptions in terms of anti-churning, because sometimes secondary sales are actually redemptions, so that we run into that also. So it's just, there's some nuanced issues that need to be dealt with, where, the company needs help, and the sellers, whoever's selling, needs to get their advice also.
Yeah, sometimes secondary can be a redemption, and all redemptions aren't bad. Only certain sized ones, correct? And so,
well, I mean, if they're more, so there's redemptions that are bad for the stock that you're holding that was issued within a time period prior to that, and then if you're beyond those time periods, then the issue is if the company redeems stock, then they can't issue additional QSBS.
Yeah. So new hires, maybe
the new hires. Yeah. So I mean, you got to kind of look at both things when you're dealing with what I call the anti-churning rules. I mean, basically, I hate to just keep, saying the same thing. You just got to know what those rules are, and you got to structure what you're doing with an understanding of those rules, so you don't find out somehow you've blown the status of either outstanding QSBS or you're locked out of issuing more QSBS for a period of time. Now, there's exceptions. I mean, if you fire somebody or they're retiring, you can, and they had service provider equity, you can buy that out. There's exceptions to the redemption rules, but there again, you want to be aware of those in advance, not scrambling to figure out how to kind of fit yourself within one a year later,
Yeah, I mean the issue comes with our founders when sometimes they also just like don't know, when you talk about anti-churning, what their needs are going to be in terms of additional issuance, additional capital raises, hires, those kinds of things within that testing period for instance, the anti-churning stuff.
Same thing.
Flexibility, I suppose, but
well, the same thing would be to avoid redemptions, but there's practical issues that come into play, on these things. And also, by the way, not all redemptions are treated as sales and exchanges. I mean, I've got situations where we've looked at things, and if you have a founder that owns 75% of the company and he's being reduced down to 55%, that'll be a dividend. That is not going to be treated as an exchange that is eligible for 1202. So you have to know that Section 302 rules for when is a payment from the company a dividend versus a payment that will be treated as an exchange, triggering the right to claim the 1202 gain exclusion.
Yeah, this is of the four sections that we've talked, the four parts that we've done so far in this masterclass series. I mean, we did substantiation last, but this is probably the one where I would say it is the most, don't try this at home. Need to have folks in your corner who, are both looking after the interests of the company, but then on the personal side, there are a lot of individual taxpayer and shareholder considerations as well. So definitely,
yeah. Don't even do it if you stayed at a Holiday Inn Express or whatever that is,
Yeah, that's good. So this article on conversions and reorgs is a great resource, especially if you're maybe the counsel that you're working with, your corporate counsel, your GC at your company hasn't had a lot of experience around QSBS and some of these things. This is a great resource, but ultimately get in touch with Scott and his team too. So, Scott, is there anything else you want to high level cover here in the last couple of minutes?
No, I mean, I think that's it. I mean, it does play into these M&A deals kind of on both sides. I think we'll talk about that next time, which is critical for planning for these roll-up arrangements. I'm sure you're seeing a lot of that activity of roll-ups of different types of companies and structuring them with the desire to have a tax-free rollover of some of the equity. That's where really the nuanced structuring comes into play. And sometimes it's not corporations with reorgs. So, I mean, we're not going to have a session on it, but a lot of the work that I'm seeing is what I call lower tier partnerships, where we have the platform C Corp, and down below we have joint ventures because people that we're rolling up are LLCs. So, they're contributing. We're buying part of their equity. They're contributing the other part to a joint venture. So they're getting a partnership interest back. So they don't have any QSBS, but they get to roll over tax free. And then maybe we have an incentive equity plan at the platform level that allows them to, kind of going forward, participate in QSBS. So, there's, like I said, it's just, it's kind of a puzzle to structure these things, but you've got to do it because you've got to try to maximize everybody's tax position,
Yep. Anything can be done until it can't be done.
Right.
Thanks a lot, Scott. And we'll see everyone on part 5. Thanks for listening to this episode of QSBS Solved. We hope to hear from you soon. Remember that the content shared on QSBS Solved is for informational purposes only and should not be construed as legal, tax, or investment advice. While we discuss strategies related to qualified small business stock, or QSBS, including rollover planning, listeners should consult their own tax, legal, and financial advisors before making any decisions. Laws and interpretations can change. Individual circumstances do vary.